Yes, it's like there's a time where I was in the market, no,
Mm-hmm.
and then it got to time. I think it was on a Monday. Yeah, it
Yeah,
was after a weekend where I noticed that there was something like there was like a jump between the market between the last from last week into this
yes,
week. There was like a big space in between, and
yes.
so I also thought, what happened here? Why is the market, why is it like why
Jumps
is there
like
space
that.
in between? Yeah.
Yeah.
So that's what I think. That's what the gap is, because I don't understand what is the cause of it, but
Mm-hmm.
that's what I thought. That's what I noticed in the
Okay.
market.
No, man, that's a good start, to notice that, this is the gap, to identify, in fact, that's a very, very, important. All right. Anyone else? Is there anyone else who have a different opinion or different idea? All right, no problem. Let's learn together. So gaps are the shape. Okay, I can see the message here. It is a reversal in a trend. All right, okay. So a gap are the shapes breaks in the price with no trading occurring in between. Like what you see, that the market jumps from one position to another without having any data, recorded on the middle, right? Without having any specific data that are being recorded or showing a candlestick that actually moves, but it jumps from one position to another, right? A gaps can happen in a moving up, it can happen gapping up, or it can happen also gapping down on a moving down, right? In the forex market, a gaps primarily occur over the weekend because it is only time the forex market are closed. So most of the time, if you are trading, if you are looking maybe without even trading, if you just say that, let me just, have a look on the stocks. The stocks open on 3:30, which is a New York session. Now it closes at around 10 o'clock, 11 o'clock. The whole time, there's no liquidity. There's no liquidity. There's no money moving in and out. It's just paused, right? But now, if let's say we take example, a stock of Apple stock, right? They produce phones, they sell phones, they produce a lot of softwares and so on and so forth. Because of Apple, it's a United States product. So it started 3:30. It ended around 10 o'clock at night. Now, from 10 o'clock to another day, 3:30, it stopped. You and me, we're not going to be able to see the market moving. But doesn't mean the business of the Apple company, it stopped. Because we might find out people in China, while we are sleeping, they are up and running. They are actually selling those phones. They're actually designing and producing those softwares, right? People from another region in the world, they're actually, up and running. They're actually doing, doing the business with that product. So that is why when you wake up the following day, you're not going to find it at the position that you left with. So you left it at 100 at night. Now you come back 3:30, the market open, it goes 120. You see the market starting on 120. It gapped it up, right? Because of the price has been moving the time that you are actually not seeing the market moving, the time that your market is actually closed. So those are one of the type of gaps that you find in a forex market. That's number one. So the gaps may also occur on a very short time frame, like the one that we see yesterday and I know beginning of this week, such as a 1 minute chart on immediately following a major news announcement, right? Take a note for the following immediately major announcement of a major news announcement. So immediately when there will be a major following a news announcement, there might be some sort of like a gap in the market, depending what type of the news is actually happening. There's people that are actually trade gaps only, right? People that are actually trading the gap only. So when the market close, they close it at 100 as a price. They say that, okay, I think when it come back tomorrow and opening, it will be on 150. right? And then they open a position, leave it like that, put a take profit at 150. When they wake up in the morning, it shoot up, it just peaks, hit the take profit, they're done. They're trading the gaps. Are we together there? Are we good? Okay, all right, let's move on. So these are type of gaps that you can see. This is gap down, leave a space. There's no any type of liquidity moving at this, and then jumps here. So those who open, let's say, for example, they open the price, the position here, and they know for sure they have studied the market or they understand the market, how it works about specific instrument that they are trading. And they say it will actually jump and get to this level. They will put the take profit at this level. Once it gap down, get to this level, it hit their take profit, it closes. Looks like it never been trading, it never been in a market, but it actually trade because they're only trading the gaps. Right? So examples of when the gapping can occur, it's actually included when the economic data is released, particularly if it is contain a data that the market isn't expected, right? So everything, it was going good. What happened yesterday, everything was going good about NASDAQ. People, you know, they're selling. We all know that now NASDAQ is falling because it's been falling from 16,000 all the way to 11,000. That's a huge, huge fall. And a lot of people, they had orders of a sale. They know for sure that this thing is selling. But now there was a huge news event that were actually, you know, happening yesterday that actually driven the economic market. And a lot of people don't know about that, right? What do we do? It will gap up. It pushes the price from where it was because of now there's so many confidence in that specific instrument to another level, to another price. So it can gap from 100 to 120 because of now the investors, they're saying that, hey guys, based on the news that are actually happening at the moment, it looks like this instrument, or it looks like this NASDAQ, it will start push up. So if you look at it yesterday, there was the biggest announcement of Apple instrument increasing the salaries, doing the breaking news that it never happened before. They are actually paying over $40 their employees per hour. So which is, it's a very, very huge to boost the American economy. People who are working at Apple companies, they're now going to start getting paid a little bit of more. They're now going to now start being able to afford a lot of things, feeding the money into economy. So it makes the NASDAQ, because of Apple, it's listed on the NASDAQ, it makes the NASDAQ to push the price up. To push the price up. Now, there was another news, there was inflation rate. There was, you know, the G10, the global 10 biggest economic countries combining together. They were having the session in Davos. They were having how they're gonna, you know, attack all these problems that we're having with oil. Things are raising up. Those are things happened yesterday. And if you didn't know, you only realize the market gapping up from one position to another. And you wonder what exactly going on. As a major news event announcing, particularly a global and unexpected news when a trading resumes after a weekend or holidays, especially if the major news is announced in that period. So far, are we good? Any questions so far? All right. It's gonna cut in 5 minutes time. Ne? Once in 5 minutes time, let's join again so that we can actually, you know, continue and complete, you know, the session. We get in a chart, we see the gaps, we do a little bit of technical analysis, then we're done for today. But once it cuts, just click the button, rejoin again. Okay. So why are the gaps important, or why are they important? Why do other people consider to actually trade these gaps, right? A gap can actually give an idea of the market sentiment. When a market gaps up, that means there was a zealot traders willing to sell at the level of the gap. Are we there? On that point, I feel like it's very, very important point. It says the gap can give you an idea of the whole market sentiment or what's going on a chart, right? What's going on that particular. So that time when you see the gap and it gapped, if you could have been, you know, a little bit of heavy, because now it gives you a little bit of idea where the market is going. The reason why it gives you the idea, it's when the market gaps up, right? It means there was a zero traders willing to push the price down, right? There were no people that are actually willing to push the price to sell or to open the position, to open the orders, thousands and thousands of orders that will push the price down. So what it does is because of there's a lot of orders that are put on a maybe, okay, let's say the price is on 100. Now on 100, there's no people that have orders to sell to continue pushing the price to 90. But there's people that are put their orders at 120, right? So the market actually jumped to go where there's liquidity. Again, when we talk about liquidity, we are talking about money that is being pumping on in a market. When you execute a trade, you are actually telling the market that this is the money that I'm putting in a market for this trade. So those are liquidity. If thousands and millions globally, they are all actually have the position of a buy position at 150, and at 100, there's no position that is being opened. The market automatically jumped from the 100 to 150. It gapped. So it gives you the idea that there's a lot of traders actually right now that actually anticipating that this trade is gonna buy. This trade, it will go all the way up, right? Already, so you have an idea, but oh, okay, if things are like this, let me also put my buy on it. You can enter your buy and start trading, you know, that instrument. Any question for that point? I actually emphasize it, you know, for a couple of times. Any questions so far? All right, so far so good. Remember, ladies and gentlemen, when it cuts, let's rejoin again to finish up everything. Okay. All right. So when the market gaps down, that means there was a zero traders willing to buy. So same applies like what I explained. The market, the market, maybe Nasdaq is sitting on 100, or let's say we're sitting on 11,000, and now you find out that there's no much more people. Actually, they are you know, they put their position for a buy, but there's more people that they put their position for a sell at 90 or at 80. The market will gap from 100 or from 11,000, come back to 11,500, because that's where these people put the orders in terms of buying, in terms of selling that product. Yes, Mr. Shadrach?
Yes, sir.
Yes, sir.
Yes, sir. I wanted to ask, like what you explained, huh?
Yes.
Does the, like, let's say if the gap happens when the market is going up, is that an indication that the market will continue with an uptrend?
All right. So it gapped up, right?
Yeah.
Yes, that's clear indication that the market will continue buying. So let's say the market was dropping, was going on a bearish trade, right? And then it's now out of the bruise from this position, gapped to here. So it actually means the people that are putting position of a sell, that are pushing the price, they are not much than the people that are actually, you know, putting the price or opening the position of a buy. So it's actually indication of a buy, right? Here's another analysis that you should look on it. The gaps mostly happens on the stocks and indices, because these are calculated in the share price, right? So if the index is combining with 100 stocks inside, one stock can drop the price, right? But if there will be people that says, yes, this stock drops the price, but I want to buy it when it reach at this level. So it actually forces the stock to move up to that level, forces the index to move the price from 11,000 to where there's a lot of people or a lot of liquidity. I'm using people so that it can be easy to us, but it's liquidity. A lot of liquidity there is. Then from there, it starts continuing pushing until maybe also something happened. More orders, they are actually, installed about the sale, or maybe more position, or the stocks is actually, dropping the price on the stock market. Now you will see it will drop bit by bit, dropping again, right? So yeah, I don't know. Did I answer you, Mr. Shadrach? All right, cool stuff. 1 minute left, guys. Let's rejoin again when it actually cuts. So a gap sometimes results in a collective price action. In other words, after the gap occurs, the price have a tendency to reverse and fill that gap. So you see